All right, so we're at the hour. Life insurance is typically has a stigma to it where people tend to, sort of think that they know and they think they understand it. And, it has negative sort of emotions attached to it. So, but I just absolutely have to shout from the rooftops the importance in securing life insurance while we can. Today's topic might be old hat for some folks, right? If you've been on this call before, we've gone over some of the basics, how it works, but I really wanted to emphasize maybe some not so thought about concepts when we think about life insurance. So LIMRA has deemed September as Life Insurance Awareness Month. And because that, this week, I really wanted to emphasize some of my experience as a financial advisor, 30 years in the business, some things I thought to be true about life insurance, and then how I've been completely re-educated on the mechanics and how it works. And I really do feel that life insurance is actually one of the greatest gifts that Congress has ever given the American taxpayer if properly structured. But without further ado, life insurance, the reason it typically causes a lot of people pause or maybe agita is because of these two words on the screen. When you put actuaries and attorneys together to create a contract, we might get a confusing look in our face. You get this deer in the headlight, ostrich wants to bury their head in the sand, this confused look, because quite often you're more confused after the advisor has left your home or after you've spoken to somebody that is supposedly a professional than when they first arose. I'm going to share with you why you shouldn't hate life insurance. And really, the number one things is because it's actually a tool. This is not your grandparents' or even your parents' life insurance anymore, right? Congress, the IRS has created and allow a lot of utilization of the benefits while you're alive. One of which is the acceleration of death benefit. I share a story that my partner had a client in California and had in excess of $2 million of permanent life insurance and was deemed, almost 15 years into the contract that they had terminal brain cancer. And having access to that death benefit while they were alive, that family was able to have a celebration of life while the person was still on this planet. So, there's a lot of benefits if we understand the mechanics of it. The other quotation here, long-term care, right, is just a very hot topic anymore. And when I'm polling, audiences at Rutgers or public presentations, I'll say, who here has heard of long-term care? And most folks will put up their hands. And how many people own long-term care? And a lot of them will put their hands down. And I go, well, why is that? And usually, unanimously, the audience will respond, it's too expensive. So, if you understand that you can access benefits, accelerate the benefits, or, depending on design, right, dealing with a professional that understands what they're doing and using the tax code, right? If you can create tax-free income, and that's a whole nother conversation. You just look at, the spending that's been going on by our government for the last 15, 20 years. We're in excess of $30 trillion of debt, right? The government has no choice but to increase taxes in the future to create income that is tax-free is absolutely, I think, paramount and prudent. And then if you can also create, if in the event you become disabled or unable to pay your premiums, that the insurance companies will step in and pay those premiums for you, it really is a tool that is worth revisiting. But here's what most people end up doing. They buy life insurance, they hear a commercial on the radio, SBLI, Select Quote, I have a Ninja Quoter on my website, right? If you want term insurance, and the way that I always explain it, just imagine all insurance is based on this. Because remember that word I said at the beginning was actuaries and attorneys. But when you think about, mathematically, right? It ends up that between 0 and age 100, the probability of death is certain. So think of those flight of stairs every year as one step. So 0 to 18, right? That's banded together, right? That's considered a minor. And usually that's one rate. And then anything after that, so you go to 19, 20, 21, 22. And when we're younger, the insurance companies know that our probability of passing is very reduced. Now, as we get older, and now we're 75, well, we only have 25 years. Statistically, in an actuary's mind, the probability of paying out a claim is much higher. So when you buy term, whether it be annual renewal, which is very rare to find anymore, 10-year term, right? So you say, okay, 10 years, all they do is take that premium from a period of time, let's say age 35 to 45, and they level that premium. Or, you're young, right? You just recently married. You have kids, you have a mortgage. So you buy 30-year term to cover your mortgage. And then you say, well, I have insurance. I have life insurance. I have life insurance through work. But all I wanted you to understand with this slide is there are no deals in the insurance industry. All they're doing is deferring the premium that you would have had to pay to a point into the future when you're quite likely to have a claim. Hopefully that made sense. So there's different types of life insurance, and that's what I was just talking about is group term and term. But I want you to equate that to renting. If you've ever rented an apartment, rented a place to live, a room, right? At the end of the day, when you were done, you had a roof over your head, but when you were done, we didn't get any money back. Here's something that most people don't realize. 99%. So think about this number, this statistic. 99% of all term insurance sold in this country never pays a claim. So if term insurance maybe isn't the best deal, it's an expense. And this is why a lot of people, when you hear it, oh, it's really cheap, it's really expensive, it's a commodity, it's something that you just have to have, it's a necessary evil. Okay, if you view it that way, I'm not saying that term insurance doesn't have a place or maybe, for specific circumstances, but we really need to educate ourselves as to what other types of products are available. Well, that brings us to ownership of life insurance, and they're wrapped in different types of wrappers, right? We have whole life, variable life, universal life, index universal life. It gets confusing, right? That's that ostrich that I showed earlier. Of all these products on the page, the one that I really have probably the most issue with is variable. And that's just because the insurance company has transferred all the risk to the policyholder. Quite often the advisor or the agent that sold it to the client did not explain all the mechanics of it. And then they end up buying something that they didn't understand, very expensive and riddled with a high amount of risk. Okay. So this is an email that I got last month, and I wanted to share this with you. Obviously, confidentiality is important, so I crossed out the names. But this gentleman wrote me a letter, said, "Let me start by telling you that as far as I know, I'm in perfect health. No lurking diseases, no weight or nutrition issues. Happy news from the doctor at each yearly checkup. I am, however, 75 years old. My wife is 74. In all likelihood, one of us is going to go first. It'll be me. It's going to be very hard for my wife, X, very intelligent, very knowledgeable, and very capable, but she's going to need some help, and she's going to need it badly. Amongst the things she'll need is money. You wrote a $200,000 life policy for me with Protective, which is fully in place. We've never been late with the payment, and I'd like to enlist your help in getting the money to X as quickly as possible. Other than the insurance, there's another policy for $240,000 with Kansas City Life. I'm not going to be leaving much of an estate. And before you get to that stage, X is going to need help and advice on dealing with the hospital, obtaining a death certificate, and getting what remains of me to a mortician. I realize you don't do things for free, but as you may not do them at all. However, we don't have family anywhere near here, so I need a professional. Can you help me with this? And if so, can you give me at least a ballpark idea what you would charge? And what I told them and I responded is A, I would be happy to help and I wouldn't charge him a fee to do this, right? I did get him some quotes because the policies that he bought 10 years ago are coming up to the point where they're going to go to that next level, that raised premium, and they're not going to be able to afford it. You know, this is where I can't teach and preach this enough, that because people buy term, I can be an order taker. I will give people whatever they ask for. But at the end of the day, right, if they don't have the money or the funds or the wherewithal to be able to do that, they've made elections that are beyond my ability to help. My point is, in sharing this, we have to take a look at what we have and realize is that what we want? Maybe we can't have the full 200 plus the 240. And again, I didn't do the Kansas City Life. I know nothing about that contract. Happy to take a look at it. And if it is permanent insurance, great. At least she has something. But I'm scared for this couple, right? So if home ownership makes sense, right, so should life ownership or life insurance ownership. These two sections of the code, 72E and 7702, are the most unique feature of permanent life insurance, is that under these two codes, the accumulation of the cash inside the contract is tax advantage. Not only can the cash accumulate tax-free, but the cash can also be accessed tax-free. Hence the beauty and magic of life insurance. It's a unique vehicle that allows tax-free account value accumulation, allows you to access your money tax-free. And when you die, it blossoms in value and transfers income tax-free. Has a lot of benefits, but it has to be properly structured. All the mechanics behind it. If you want some light reading, this is a textbook for actuaries. I have one sitting on the shelf behind me. I'm more than happy to go through that, and you can put yourself to sleep at night, right? But what I do is give the Reader's Digest version. And this is just an example of how it works. And typically when I'm designing permanent insurance for folks, right, we have to start to think about, if we really truly in our heart of hearts believe that income taxes are going to be higher in this country, why are we saving in 401ks? Why are we saving in IRAs? Why are we saving in TSPs and 403Bs and any tax deferred vehicle the government gives us? Because there's an unknown there. And that is, what is the future rate of taxation? So this is why I'm so adamant about it, because cash value life insurance is one of the few tools that we can create super Roth-like environments, but it has to be properly structured. So real quickly, I'm going to go through this quick. The first thing is that, you know, in this hypothetical example, there's a $500,000 death benefit, and there's a minimum premium that can be charged. There's also a maximum premium that can be charged. The question I will typically ask somebody is, do you know who determines the minimum premium? And the answer is the insurance company. Do you know who determines the maximum premium? And the answer is the government. The fact that the government is even remotely interested on how much cash we can get inside of a life insurance contract should tell you one thing as it relates to taxes, and that's that it's good. But there's rules that have to be followed, right? Anything that goes in above, whatever that design is, all that means is now we lose the tax favored environment that we created, and now it works like our 401k or our IRA. So what, in this example, let's say the insurance company says, I need $1,000 to be able to cover the death benefit, but the maximum the IRS says you can put in is $10,000. That means I can squirrel away $9,000 and have it grow and compound tax-free. Very powerful. And with that, you're going to get all these benefits, right? I'm not going to go through the whole list. The only one I want you to notice that is grayed out at the bottom, and if anybody tells you you can get this, I want you to run, because they don't know what they're talking about. I do not delve into gray areas. And there are people out there that, oh, you can take the life insurance premium as a tax deduction. No, you can't, right? If you try, the IRS is not going to let you take a tax deduction on the left side of the balance sheet and then turn around and have that money come to you tax-free on the right side of the balance sheet. So just understand it, but everything else you can get, right? We can get tax deferred growth, tax-free contribution, competitive rates of return, predictable rates of return, high contribution limits, above and beyond typically what we can get inside of an IRA or 401k. So there's many, many advantages, but it has to be properly designed. And then this is one of the tools is something called Index Universal Life, and they use something called indexing. And the way that I explain this is, look, let's say that we had two accounts sitting side by side. Both of them started with 100 grand, right? And at the end of the year, let's say that 10% was the gain of the account. Not uncommon for a mutual fund, but it's also possible within an IUL. The only difference between an IUL and a mutual fund is because they're not in the market. That's a key statement. Life insurance does not in a IUL. Remember I said variable, you're in the market. Those are called separate sub-accounts. You're in the market with all the risks. With an IUL, you are not. You're just tracking an index, something like the S&P. So if it went up 10%, that gets locked in contractually, never to be given back. But somebody that's in a mutual fund, I'm certain that most people on this call just, have probably stopped opening your 401k statements or your investment statements because of the market volatility of late. So what goes up 10% can come down 10%. The person that was in the mutual fund with all the risk, right, and the tax deferral, 10% loss of 110 is 99,000. Now you're below what you started. But somebody that was in an IUL did not lose their principal. Now, not every year is going to be a 10% gain. Let's say the next year is 5%, right? So it went down 10. The person we were locked in at 0, next year's a 5% gain. So in a 3-year period, somebody in an indexing strategy might end up with 115,000 versus somebody in the market with all the risk at 103. So that's one component to indexing. The second component, and I think the secret sauce that a lot of people just, it takes them a while to get their head around it until I explain it to them. Keep a note of that 115.5. We're going to start in our indexing chart on the next slide. So this is typically what the market might look like, right? Let's just call it the S&P 500. It was started at 940 and dropped to 40%, right? To 650. But because they were in an index product and not in the market, it just tracked it, that year they're going to get a 0. You're going to get a 0. You didn't lose your principal, but I didn't give up 30%. And not every year are we going to get 10%. But from here, the market goes from, this is what somebody will say, well, 650 went back to 920. It's capped out at 920. Didn't even get back to even. But that 115 got a 10% credit. And now it's at 127. This is how indexing works. It's just, whether it's whole life, whether it's UL, I'm doing a quote for somebody in New York that said, hey, listen, you know what? I'd like to leave some money to a charity, but I don't want to pay it forever. Well, if you're the whole life, typically you're going to be paying larger premiums, and usually they're for the life of the contract. There's what you can do 10 pays. Now he's 68 years old. So I ran some different scenarios for him, but I also ran something called GULs, Guaranteed Universal Life. There's a lot of different products out there, and it does get confusing. So I'm here to help. I just wanted to make you aware, this is the book. If you'd like to learn more, I can send you a copy of the book, Wealth Beyond Taxes, Kaizen. There's a lot of strategies that you can take advantage of. You should probably explore and look at. But here's the biggest thing. You got to qualify for life insurance. Right? Insurance industries do not give contracts to where they're likely to pay a claim. So they're going to do as much of their due diligence up front. And then, if something happens, right, they're on the hook. That's why you want permanent insurance versus term insurance where they're like, okay, you get to, do a small medical. Sometimes maybe even they have advanced or simplified underwriting. A lot of things have changed in this industry, depending on the amount of coverage. So hopefully I didn't put you all to sleep, but I really do think that this was important. I do see I have 2 notes in chat. The other thing I want to point out before I let everybody go is if you have term insurance through your employer, group term insurance is some of the cheapest insurance that you will have. I just got an email from one of my clients today that their job is they're being let go in January next year. You don't own that insurance. So now what happens is you're now getting, not only losing your job, right? But you now have to turn around and figure out, are you insurable? And what kind of insurance do you have, and what's your obligations, and what would happen if something happened to you? Would your family be able to survive? These are tough questions that people that, typically we're not sitting around the dinner table talking about this stuff. But if I can help, I'm here to help. I'm going to, here's one thing, I'll leave you with this. I am not going to tell you what you want to hear, but I am going to tell you what you need to know. Folks, have a great day, right? It's September, it's Life Insurance Awareness Month. No call next week. And then I'll see you back in the third week of September, and we'll go over a market update. So stay well, and I'll talk to you soon. Bye-bye.